What's going on, everyone? Today's the last day before the most historic FOMC meeting that anyone's ever seen for the last 30 to 40 years. We're going to look at the repo today and go over it a little bit because I know this is an area of confusion and a place that a lot of people overlook. And this one area of the market is literally controlling everything, and it's all surrounding it. And this is the primary reason why most people are about to get caught off guard with what's going to happen in the markets. So today we're sitting here at $2,238,870,000,000 in the repo. The offering rate here is 2.3. After tomorrow, later this week, you should see the rate hike that's coming reflected in this rate here, and it's been going up. Back in 2020, it was 0, and for a brief time, it actually fell below 0. And when that period of time was occurring, markets were going up because rates were going low, but it went up on leverage. Now, when it comes to the repo itself, I hear a lot of people comparing the current day to 2008. You can't do that because look at this here chart. This is measuring from 2003 to 2021. As you can see here, this repo demand that we have currently has never even came close. The last previous height that we had that was remotely even near this, but not really at all, was 2017. That's when LIBOR to SOFR started, which is basically the entire big picture is LIBOR SOFR. Now, when it comes to LIBOR to SOFR, the SOFR is the secured overnight financing rate, which is the repo. SOFR is the repo. Now, when it comes to it, we're going to read this fact sheet here from ARRC. This is an Alternative Reference Rates Committee, SOFR Starter Kit, Part 2. Also see Part 1 and Part 3. Let's look at Part 1 real quick. So this is some background on USD LIBOR. What is LIBOR and how is it calculated? Well, LIBOR is a series of interest rates intended to reflect banks' average cost of short-term, wholesale, unsecured borrowing. It is currently used in many financial products worldwide, from derivatives, primarily derivatives, to mortgages, to bonds, and corporate loans. It is currently calculated for 5 currencies and in 7 tenors, or lengths of time, like 3-month or 12-month LIBOR. Each business day, a panel of banks for LIBOR in each currency, 16 banks for all USD LIBOR, submit their estimates of the cost to borrow in wholesale unsecured funding markets. For each tenor, the upper and lower quartiles are removed, then the rest is averaged to determine the LIBOR rate for that day. This happens on a daily basis. And it says here, what are the problems with LIBOR? Why is LIBOR being replaced? Changes in the way banks fund themselves have caused the volume of transactions underlying LIBOR to decline considerably. In 2019, this is exactly what happened. Today, the markets for unsecured wholesale term borrowing by banks is not sufficiently active, with a relatively small number of transactions underpinning LIBOR. LIBOR is sustained through expert judgment, which means panel banks submit estimates of their borrowing costs with little actual borrowing activity to validate them. For example, on a typical day, the volume of 3-month wholesale funding transactions by major global banks was about 500 million, and just 7 daily transactions on average make up this volume. Compared to the 200 trillion of financial contracts referencing USD LIBOR, that number is minuscule. So basically, 500 million out of 200 trillion, that is minuscule. This scarcity of transactions as underlying markets calls into question the scarcity of transactions in underlying markets calls into question LIBOR's sustainability. So this is what caused them to pursue the transition, and this began in 2014. In 2014, global regulators highlighted the financial stability risk associated with over-reliance on LIBOR. In response, national working groups in jurisdictions worldwide, like the ARRC, were converted to support a transition away from LIBOR and other LIBOR-like rates by identifying robust alternative interest rate benchmarks anchored in deep, active markets. In 2017, those efforts were accelerated when the Financial Conduct Authority, the UK government body that regulates LIBOR, stated that it had exerted considerable effort persuading panel banks to continue submitting LIBOR, and that it brokered a voluntary agreement with the remaining panel banks to continue submissions through the end of 2021. In April 2020, following the outbreak of COVID-19, the FCA reaffirmed that timeline, announcing that the central assumption that firms cannot rely on LIBOR being published after the end of 2021 has not changed and should remain the target date by which all firms should prepare for LIBOR to be unusable. So out of the entire situation, you have 200 trillion of activity referencing the USD LIBOR. You have 190 trillion out of that is derivatives. So 95% of that is going to be derivatives. 3.4 trillion is for business loans. 1.8 trillion is for Federal Reserve notes. 1.8 trillion is for securitizations. And then 1.3 trillion is for consumer loans. And then less than 500 million of underlying daily transactions. So that's a huge problem. So history of the ARC and the selection of SOFR. I'm not going to get into that. That's just the company that made this alternative reference. So I'm going to close out of that. I'm going to go back to part 2 here. How SOFR works. In 2017, the ARC selected SOFR as its preferred alternative to US dollar LIBOR. SOFR is a broad measure of the cost of borrowing cash overnight, which is where we get the repo demand from, collateralized by US Treasury securities in the repurchase agreement. SOFR has several characteristics that make it much safer and less vulnerable to manipulation than LIBOR, including that it is based on active underlying market with a diverse set of borrowers and lenders, is based entirely on transactions, and this is not true. You can go look on the OFR, and it is not a diverse set of borrowers and lenders. It's all the big banks and all the money market funds. It's produced in compliance with international best practices, and it covers multiple market segments, ensuring robust transaction volumes in a wide range of market conditions. Now, they're going to get into the repo here. The repo market overview. SOFR reflects transactions in the Treasury repo market. Repos are conceptually straightforward. They effectively are collateralized loans, in many ways similar to mortgages in which homeowners borrow money using their homes as collateral. But instead of their homes, they're using debt and securities as collateral. And keep in mind, when reading these alternative references, you got to keep in mind that some stuff will be changed because there is supernotes in the actual source filing. And I'll go over the collateral that's actually in the Fed so you can see. But they're actually going to get into borrowing. So, reasons for borrowing secured funds. When a borrower secures a loan with collateral, the lender has more options to get repaid. After all, if the borrower fails to repay the loan, the lender is able to take possession of the collateral and sell it to recover the funds lent. Lenders are therefore typically more willing to make secured loans, like repos, than unsecured loans, where the lender does not have the benefit of collateral to guarantee payment. Now, repo market participants. They're going to claim that there's a wide variety, but there's not. It's only the biggest players in the market. So there's a wide variety of market participants directly involved in the Treasury, including asset managers, banks, broker-dealers, corporate treasuries, insurance companies, money market funds, pension funds, and securities lending agents. All of these parties are in the repo. When it comes to the Fed, though, primarily the Fed is transacting with money market funds, which are Fidelity, State Street, BlackRock, Vanguard, Schwab, all those big names. Out of these parties, though, if you look at the repo market as a whole, other accounts for 39%. This is for the FICC GCF repo. GSIBs, which is globally systematic important banks, are 33%, and then non-globally systematic important banks are 28%. Now, there are a wide variety, again, to understand the diversity of institutions involved in the Treasury repo market. This is Treasury. Remember, there's a few different repo markets. You have the Treasury FICC, you have the Fed repo, and then right here it says in 2020, FICC has accounted for only 60% of SOFR's roughly $1 trillion in daily transaction volume. That segment alone involves roughly 2,000 institutions through its members and sponsored members who are able to transact in the Treasury repo with FICC. Beyond the diverse entities that regulate or that regularly transact directly in the repo market, there is a significant number of entities with indirect exposure. And this is what's important. The indirect exposure that's going around. That is what everyone has not looked at. For example, any investor in the 4.5 trillion money market fund industry that likely has exposure to the repo market. Any investor in the 4.5 trillion money market fund industry likely has exposure to the repo market due to ETFs and interfund lending. Similarly, pension funds like the California Public Employees Retirement System, which serves owner to 2 million people or 2 million members in the retirement system, typically lend cash. So again, remember, we've been over this before. Insurance companies are cash lenders, and the hedge funds are securities borrowers to make markets with, and it's all going through the repo. Even if you're not in it directly, even if GameStop and AMC's not in the repo directly, it still has exposure from it indirectly. That's the key to take away from it. So basically, that's been the whole thing. So SOFR by the numbers. Look at 2019. This graph right here, the 90-day SOFR average and the 3-month USD LIBOR plummeted at the very tail end of December 2019, heading into SLR. SOFR outstanding notational and total volume, starting from 2018, it just has been ramping up ever since. You also have common misconceptions of SOFR. And I'll link this below if you want to read it. That's all I'm going to get into for now. But the repo, it's the key aspect of the market. No one's looking into it. Everyone's wanting to just choose and be complacent, ignore filings, ignore changes that are coming out, and yeah, this shit's real. There is a part 3 as well. Let's see what this goes over. Best practices. This is an old timeline here. User's guide, fallback language. So yeah, I'll link this stuff below. Anyways, y'all have a good one. Repo is still at all-time high, and inflation will not come down until this shit comes down.